You showed up on your first day expecting a marble lobby, a guy in a blazer holding a clipboard, maybe a fountain. You'd read the job posting 3 times before applying: controller, private family office, $500 million plus AUM, and you'd built a whole building in your head before you ever saw the real one. Instead, you got a converted dentist's office above a dry cleaner in a suburb nobody photographs, a buzzer with 4 names on it, and a woman named Odalis who handed you a coffee in a mug that said world's okayest golfer and told you IT support was whoever fixes it fastest. Your name is Emmett Voss. You're 26, you have a CPA license 11 months old, and you were hired to help manage money for a family whose fortune came from a company that makes the plastic trays inside vending machines. Nobody has ever heard of it. That's sort of the point. You'd learn. You walked in thinking $500 million would announce itself. Instead, the first thing you noticed was the carpet, the same beige commercial loop carpet as your old apartment complex, worn thin in a track from the door to the kitchenette. The second thing you noticed was the founder himself, a 71-year-old man named Harlan Castellan, standing at the counter in a golf shirt with a hole starting at the collar, rinsing his own mug in the sink because the dishwasher was broken and nobody had called anyone about it yet. You'd expected performance. You got a guy who drove a 9-year-old Tahoe and packed his own lunch in a Ziploc bag, sitting in a room where 5 people quietly ran his entire financial life: his trusts, his taxes, his aircraft sharing agreement, his 3 grandchildren's 529 plans, his stake in 11 private companies you'd never heard of, and where the biggest visible extravagance was a Keurig nobody had descaled in a year. Your desk was a folding table for the first 2 weeks. Your laptop still had a sticker from IT Asset Management peeling off the lid. And on day 3, Odalis, who you'd learned was actually the CFO, not some office manager, despite the mug and the sink duty, slid a spreadsheet across that folding table and said, "Before you touch anything else, I need you to understand what this whole thing costs to run." Most people never see this number. You're about to. You looked at the tab open on the screen. A single cell, formatted in bold, sat at the bottom of a long column of line items: total annual operating cost. You didn't know yet what half those line items meant: tax director, K1 aggregation, family governance retainer, but the number at the bottom made you sit up straight in the folding chair. That number is where this story actually starts. Because what you were about to learn over the next 4 months inside that office above the dry cleaner wasn't about mansions or jets. It was a much stranger question, and a much more useful one. What does it actually cost, in real dollars, to manage $500 million privately? And at what size does that machine even start to make sense? The number at the bottom of Odalis's spreadsheet was $3,180,000. You stared at it long enough that she reached over and scrolled up, back to the top, so you could see how it was built instead of just gawking at the total like a tourist. "This isn't a bank account," she said. "This is a company." You just don't clock that at first because nobody's selling anything and there's no sign on the door. That was the thing nobody tells you about a single-family office. The term itself, SFO, which you'd seen in the job posting and assumed meant something loose, like a guy with a Bloomberg terminal and a filing cabinet. It doesn't. It means a real operating entity with a real payroll, real office lease, real insurance, real software licenses, built for exactly one client, the family that owns it. And that entity was sitting on top of $500 million the way a corporate headquarters sits on top of a factory, invisible to the product, essential to the output. Odalis walked you through the org chart first, because the org chart was where most of the money went. At the top, functionally, sat Harlan himself, not managing day-to-day, but the reason any of it existed. Below him, doing actual work, was a CIO named Priyanka Reyes, who you'd meet properly on Thursday, a woman who'd spent 14 years at a hedge fund before Harlan poached her with a title, a garage, and a promise she'd never again have to explain a drawdown to a committee of strangers. Odalis herself sat as CFO and controller combined, at least until you were fully ramped, which was apparently the actual reason you'd been hired, to take the controller half off her plate so she could focus on tax structuring and the family's stake in that vending tray company, which was still improbably growing. Below the two of them, a tax director, a woman named Farah, who worked 3 days a week and billed like she worked 7, handling the K1s that came pouring in every March from 11 different pass-through entities. Outside counsel on retainer, not full-time, a law firm 40 minutes away that handled trust amendments and the aircraft sharing agreement and anything with real legal teeth. 2 analysts, 1 junior, and 1 who'd been there 6 years and functioned more like a deputy CIO. A chief of staff named Reginald, who you initially mistook for household staff because he answered Harlan's cell phone, but who you'd later learn also sat in on every investment committee meeting and had veto power over travel spending. And underneath all of that, quietly, a part-time bookkeeper for the family's household accounts, a property manager who handled 4 homes and a boat slip, and a concierge, one person, contracted, who booked flights and handled the kind of logistics that had nothing to do with money and everything to do with keeping Harlan from having to think about his own calendar. Count them, Odile said. Go on. You counted. 9 people, more or less, touching this money in some capacity, not including outside counsel and Farah's part-time hours. 9 people, for one family. Now guess the payroll, she said. You guessed low, because you were used to thinking about salaries the way most people do. A controller makes X, an analyst makes Y. You said something like $600,000 total, feeling embarrassed the second the number left your mouth. She shook her head and pulled up a different tab. Priyanka's total comp, base plus a small piece of carried upside on the portfolio's alternative sleeve, ran north of $400,000 on its own. Odalise's own comp, which she showed you without flinching, sat just under $300,000. Farah's part-time tax work billed out at a rate that annualized to roughly $180,000 for 3 days a week. The senior analyst pulled $220,000. The junior analyst, closer to your own level, sat at $95,000. Reginald, the chief of staff, cleared $250,000 because he was effectively running Harlan's operational life and had the discretion of an executive, not an assistant. Add the part-time bookkeeper, the property manager's fee, the concierge retainer, and you were already past $1.5 million before a single dollar of rent, software, insurance, or outside legal work had been counted. Staffing alone is usually 50 to 60% of what an office like this spends every year, Odile said. People assume the expensive part is the fancy stuff. 90% of it is just paying smart, discreet, loyal humans enough money that they never once consider leaving for a hedge fund that'll work them to death for a bigger number. She scrolled to the rest of the tab so you could see where the other half went, and it was almost anticlimactic in how ordinary it looked. Rent on the suite above the dry cleaner, $58,000 a year, because Harlan refused to pay for a nicer address nobody but staff would ever see. A portfolio and partnership accounting platform, the kind built for institutions, not individuals, running $64,000 a year in licensing before anyone touched a spreadsheet by hand. Errors and emissions insurance for the whole operation, $41,000. Outside counsel's retainer, separate from Farah's tax hours, another $95,000 a year just to keep the trust attorneys on call. A cybersecurity contractor who did nothing but monitor for wire fraud attempts against the family's accounts, because at this size, someone eventually tries to spoof an email and ask Odalise to move 7 figures to a new vendor, $38,000 a year for that alone. Small numbers next to the payroll, individually. Add them up and they were the other $1.4 million. None of this counted what it cost to build, Odalise added, almost as an afterthought, closing that tab. Standing an office like this up from nothing, the legal formation, the platform build-out, the first year of recruiting people like Priyanka away from places that paid them well to stay, that's typically $500,000 to $1.5 million, one time, before you've run it for a single full year. Harlan didn't blink at that part. He blinked at the idea of doing it badly. You did the arithmetic she wanted you to do without her asking. If payroll alone was somewhere near $1.6 to $1.8 million, and payroll was maybe 55% of the total, the whole operation had to be running somewhere close to $3 million a year to function, which lined up almost exactly with the bold number at the bottom of the sheet. $3,180,000. On $500 million, that worked out to a little under 64 basis points. Not the cheapest an office like this could run. Offices past $1 billion often get that down closer to 36 basis points once the fixed costs spread across more assets, but not the most expensive either. Offices sitting under $500 million, she told you, often average something closer to 105 basis points because the fixed costs don't shrink just because the portfolio is smaller. You still need a CFO. You still need a tax director. You still need someone answering the phone. The bill for competence doesn't scale down with the account balance. There's a reason nobody does this under $100 million, she said, tapping the screen. Below that, this same staff, this same overhead, eats an unreasonable slice of the pie every single year. At $100 million, $3 million of fixed cost is 300 basis points. That's insane. Nobody rational pays that. At $500 million, the same $3 million is a much more sane number. At $1 billion, it gets sane enough that some families build entire campuses around it. You asked, because it was the obvious question and you'd been sitting on it since the folding table. Why anyone would build this from scratch instead of just hiring a normal financial advisor. Because, she said, a normal advisor is optimizing for one thing, the portfolio. Nobody in this building is optimizing only for the portfolio. Priyanka manages the money. I manage the money's relationship to 12 different tax jurisdictions and the 4 operating businesses Harlan still half runs from that Tahoe. Farah keeps the IRS from ever needing to know his name. Reginald keeps Harlan's actual life running so he can show up to investment committee without also mentally packing for a trip to see his sister in Tucson. You don't build this because you want a fortress. You build it because, at a certain size, letting all of that sit scattered across 6 vendors who don't talk to each other becomes its own kind of risk. This is expensive. Fragmentation is more expensive. It's just slower to notice. You met Priyanka properly that Thursday, exactly as promised, and she didn't look like what you'd built in your head either. No Bloomberg terminal glow, no framed tombstones on the wall from deals she'd closed. Just a woman in running shoes eating a salad out of a Tupperware, reviewing a private equity capital call on a second monitor while she talked to you with the first. You asked her, half joking, if she missed the hedge fund life, the bigger numbers, the bonus pool that probably dwarfed her comp here. I manage 1 book now instead of 40, she said, not looking up from the capital call. Nobody's redeeming on me because their year was bad. Nobody's asking me to explain a bad quarter to an allocator who read 1 Bloomberg headline. I get paid to be right over 5 years, not right every 90 days. That's worth more to me than the number on the old paycheck, and I say that as someone who did the math twice before I took this job. She closed the laptop before you could ask the next question, which was already forming in your head, half-shaped and uncomfortable. If this only worked because there was $500 million behind it, what happened to families who built the exact same structure with half that much, or families who'd once had $500 million and, quietly, over a bad decade, didn't anymore? That question, it turned out, had an answer. You'd get it 3 weeks later, and you wouldn't even have to ask. Priyanka's door was open maybe 4 inches, which in that office meant nothing was private because nobody ever bothered closing doors all the way in a suite that small. You were walking past with a stack of statements when you heard her say a name you didn't recognize, Delacroix, and then a number that stopped your feet. 42 million isn't enough to keep doing this, Bram. You know that. I've watched 3 families try. You stood there longer than you should have. She was on speakerphone with someone who ran a competing setup 2 towns over, a much smaller shop that served a single family whose fortune, once well north of $100 million, had shrunk through a divorce, a bad venture bet, and a decade of just plain spending. $42 million is still, to any normal person, an incomprehensible amount of money. But Priyanka wasn't talking about whether the Delacroix family was rich. She was talking about whether they could still afford the shape of rich they'd built around themselves. They kept the same 4 people, she said into the phone. Same CIO, same controller, same tax guy, same office lease. Nobody downsized because nobody wanted to be the one to say it out loud. Now they're burning something like 2.5% of the whole portfolio every year, just keeping the lights on in a structure size for money they don't have anymore. 2.5%, Bram, on assets that keep shrinking because 2.5% is walking out the door before a single dollar gets invested. You didn't understand yet why that mattered so much, but Priyanka waved you in when she noticed you hovering, hung up a minute later, and told you to sit. You're wondering why nobody just downsizes, she said, before you'd asked anything? Same reason nobody moves out of a house they can't afford anymore. Pride, mostly. And because unwinding a family office is humiliating in a way that hiring one never is. Nobody throws a party when you fire your tax director. Then she told you the thing that actually mattered, the thing that, up to that point, you'd assumed simply didn't exist as an option, because nobody in the building above the dry cleaner had ever mentioned it. There's a whole other category of shop built specifically for families who don't have $500 million. It's called a multifamily office, an MFO, and instead of one family footing the entire payroll for 9 dedicated people, dozens of families share the same CIO, the same tax team, the same compliance infrastructure, and each family just pays a fee for the slice they use. Something like 0.5% to a full percent of assets, plus a flat retainer that typically runs somewhere between $25,000 and $250,000 a year, depending on how complicated the family situation is. No fixed headcount to carry, Priyanka said. That's the whole trick. If the tax director costs $180,000 a year and you're one of 40 client families splitting that cost roughly by size, you're paying a sliver of $180,000, not the whole thing. You get institutional grade help without owning the institution. She pulled up a website on her second monitor, a multi-family office 2 states over that she'd apparently pitched against for a prospective client the year before, and walked you through how it actually worked on their end. One CIO covered 19 client families. One compliance team covered all of them. One tax department, 4 people, filed for every single household on the roster, whether that household had $40 million or $400 million, and the fee each family paid simply scaled with their slice of the total assets under management. A family with a complicated situation, multiple trusts, a business interest, kids in 3 states, paid toward the higher end of that half to 1% range, and a retainer closer to $250,000. A simpler family with a single brokerage account and a vacation home paid closer to 0.5% and a $25,000 retainer, barely more than a decent private bank charges for a dedicated relationship manager. The families who use these right, Priyanka said, get almost everything Harlan has, minus the part where they own the building. They just can't customize every last piece of it, and there's no one person whose entire job is obsessing only over their family. That's the actual trade-off. Not worse service. Less exclusivity. You did the math out loud, mostly to see if she'd correct you. A family with, say, $60 million, paying a multi-family office 0.8% plus a $75,000 retainer would spend somewhere around $555,000 a year for full-service management, tax, investment, reporting, the works. The same family trying to build a standalone single-family office, hiring even a lean version of what you'd counted on Odalis's org chart, a generalist CIO, a controller, an admin would be staring down $800,000 to $1.2 million in salary alone before touching rent, insurance, software, or a single outside legal invoice. On $60 million, that's not 60 or 70 basis points. That's well over 150. It's not a discount version of what Harlan has. It's a much worse deal, dressed up to look like the same status symbol. There's a rough line where it flips, Priyanka said. Most people who study this put it somewhere between 75 and 150 million in investable assets. Below that, the math almost never works in favor of building your own. The fixed costs don't care how big or small your pile of money is. A controller costs what a controller costs, whether you're managing 60 million or 600. Above 100 million, roughly, those fixed costs finally start shrinking as a percentage of the whole thing fast enough that owning your own shop starts to make sense instead of just feeling like it should. You thought about where that left an ordinary person, someone with a decent 401k, maybe a taxable brokerage account, nowhere near 8 figures, let alone 9. Priyanka must have clocked the look on your face, because she answered the question before you asked it. You know what a normal advisor charges the average person walking into a branch office with $300,000 saved for retirement? About 1% of assets a year? Same basic idea, you're paying someone to manage money you don't have time or expertise to manage yourself, just at a completely different point on the ladder. Harlan pays roughly 60 basis points and gets a company. A family office client at 50 million might pay 80 basis points and gets a team. A retail investor pays 100 basis points and gets an app and a quarterly call. It's the same fee logic wearing 3 different outfits. This is genuinely the part where most people's eyes glaze over, because fee structures sound like homework. It's also, not coincidentally, the exact part our book walks through slowly with real numbers instead of a 2-minute video summary, how basis points actually compound against you over 20 or 30 years, how to tell if you're the retail client paying too much or the family office client paying for something real, the whole ladder laid out with worked examples instead of vibes. It's on a discount this week, links in the description, and if any single section of that book earns its price, it's the fee chapter, because that's the chapter that would have saved the Delacroix family 2.5% a year, if anyone had shown it to them 5 years earlier. Priyanka wasn't finished, though. She leaned back, and for the first time since you'd met her, she didn't sound like she was teaching you something. She sounded like she was warning you. The dangerous part isn't the family that never had 100 million, she said. It's the family that used to have 500 and doesn't notice for a while that they're down to 80. The structure doesn't send you a memo when it stops making sense. It just keeps running, keeps paying 9 salaries, keeps leasing the same office, right up until someone finally opens a spreadsheet like the one Odali showed you and realizes the machine has been quietly eating the thing it was built to protect. You thought about Harlan rinsing his own mug in that broken dishwasher. You thought about the Delacroix family, whoever they were, still paying 4 salaries for money that used to justify them. And you thought, for the first time since you'd walked in expecting a marble lobby, that you finally understood why the office looked the way it did. Plain carpet, a folding table, a guy in a golf shirt with a hole in the collar. Not because Harlan was hiding his wealth, because everyone in that building already knew exactly what it cost to keep it, down to the dollar, and had stopped needing the building to prove anything to anyone. You stayed at that office long past the point where any of it still felt like a job. You watched Odalise close the books at year-end and land within a rounding error of the number she'd shown you that first week on the folding table. You watched Farah's March Quick 1 marathon nearly break her, and watched Harlan once quietly wire her a bonus that had nothing to do with her contract and everything to do with the fact that he knew exactly what she'd carried for him that spring. You watched Reginald talk Harlan out of buying a fourth plane share, not because Harlan couldn't afford it, but because Reginald had run the numbers on utilization and it simply wasn't a rational way to spend the family's money, which is, in the end, the entire job description of everyone in that building. Not spending money, guarding the decision to spend it. Here's what you actually learned underneath all of it. A $500 million family office was never a trophy. It was a company with a payroll and a lease and a bold number at the bottom of a spreadsheet that only makes financial sense once the fortune behind it is big enough to make roughly $3 million a year in fixed costs look small instead of insane. Below around $100 million, that same structure isn't prestige. It's a leak, and the people who get hurt by it are never the ones who build it at $500 million with their eyes open. They're the ones who build it at $60 million because it looks like what rich people do, or the ones who keep it running for years after a divorce or a bad decade quietly drops them out of the bracket that ever justified it in the first place. That's the expensive mistake hiding inside this whole topic, and it's a quiet one, which is exactly why it's dangerous. A family clinging to a full single-family office structure below that $100 million threshold, or staying loyal to one after their wealth has already slipped under it, bleeding out 6 to 7 figures a year in fixed overhead nobody re-examines. Sometimes for 2, 3, 4 years before anyone in the family actually opens the spreadsheet and asks why the fee line keeps eating more of the pie than the portfolio is growing. If you want the full math on where that line actually sits for your own numbers, and how to tell which side of it you're really on, that's exactly what the book breaks down, links in the description below.